here on how to position your portfolio into the year end and 2025 is Burns McKinney, who's the NFJ Investment Group Managing Director and Senior Portfolio Manager. I mean, Burns, at this point, we're, a stone's throw or, just a handful shy of that 50 marker, 50 new all-time highs here over the course of 2024. And so what is this market really continuing to look for or just latch onto in this broader momentum that we've been tracking, and especially amid an earnings season that can tend to have some of those more outsized names, send a broader signal across the market?
With the market hitting records, it seems seemingly daily or weekly, I think that, is a wiser investor than me that once said, "Don't fight the Fed." And this is a great example of that. Oftentimes when the Fed pivots to cutting interest rates, if they're doing that to stave off a recession, that's usually a bad sign for stocks going forward. But in this case, the fact that the Fed is doing it from a point of strength, they're really reducing rates not because they feel that a recession is imminent, but rather because the inflation-adjusted Fed funds rate has just gotten so restrictive that they're just trying to really bring it back to a neutral level. And so with the Fed cutting interest rates, that should provide a little bit of a tailwind going forward. And that's really what's been boosting equities, day after day, it seems like.
A tailwind for which sectors from your purview?
That's a great point and a great question. In fact, if anything, what we're seeing is because the economy has proven itself to be somewhat resilient, in many ways, a lot of investors are saying that you're looking at a little bit of a Goldilocks-type environment. That's really keeps it primed for maybe a continued rotation away from a lot of what's really driven the markets over the last couple of years into some of the areas that have been out of favor. When the central bank starts cutting interest rates, places like the bond proxies tend to do well. That works well for utilities, industrials, and just anyone who's selling machinery and equipment also tend to get a bit of a boost when you do start seeing lower interest rates. And likewise, the industrials benefit from a lot of secular tailwinds, such as geopolitical turmoil is boosting the defense stocks. You still have a lot of dollars going out the door for the infrastructure spending programs, and just the reindustrialization of the United States provides a bit of a tailwind for some of those industrials names.
Just further down the line of what you were mentioning a moment ago with utilities, do you think that there's still room to run, considering the fact that we're taking a look at XLU here, even utility sector for the S&P 500, it's up 27% year to date here. So is utilities having an overflow or getting some type of bite or sniff at this AI moment even that we're seeing?
Well, if you pan out a little bit on your time horizon, there actually does seem to be a little bit more meat on the bone. Utilities, they trailed in 2022, they trailed in 23. In fact, 2023 not only was utilities the worst sector in the market, but their relative performance compared to the S&P was actually the worst relative performance for utilities since 1999. You're talking about, so you hadn't seen this bad a performance for utilities in 25 years. And so when one factors that in, when you factor in the fact that, we were just speaking about the fact that the market's hitting record highs, you're seeing high valuations on the market. There is a lot of uncertainty. And so that also makes a case for looking to something a little bit more defensive in the case of utilities, looking something like those dividend yields. And, as well, I think they're getting a boost from the fact that, yes, just increased demand for AI, cloud computing is starting to drive, rises in power demand.
Burns, while we have you, I got one of my first December 2025 S&P 500 targets in my inbox just before we came on air, and from UBS saying that they're looking and introducing a December 2025 price target of 6,600 for the S&P 500. With that in mind, what do you think needs to go right, and what are the risks that the market needs to move through?
Well, as I noted, you don't want to fight the Fed, but that said, given the fact that you're looking at S&P with a price to earnings ratio of 23 times earnings, which over the last several decades, it's only been higher during a brief span in 2020 as well as during the dot-com bubble. So you're looking at high valuations, and if you look at the consensus forward earnings forecast for the S&P, Right now, those are factoring in 15% earnings growth next year, whereas over the last couple of decades, the average earnings growth has only been 8 or 9%. And so there are a lot of aggressive assumptions baked in there. So in many ways, that is priced for perfection. So what we're arguing is that because the Fed does provide a tailwind, we do expect positive returns going forward. But it's really going to be you're not looking at long bombs down the field. It's probably more like 3 yards in a cloud of dust. Investors should probably expect good enough equity returns in the coming 12 months.
All right. Well, Derrick Henry might love to hear that. Burns McKinney, NFJ Investment Group Managing Director and Senior Portfolio Manager. Thanks so much for taking the time, Burns.
Thank you for having me.